Now for a bit of a look at what we can expect on our own market today. We're joined by Evan Lucas from IG in Melbourne. Your thoughts for the session ahead, Evan?
Yeah, look, our session ahead is probably going to be a little bit negative. We are pointing down roughly around about 20 to 23 points. Have seen calls even a little bit lower than that. And I think, again, it gets back to what's going on, not just in the US, but also having a look at where we're currently sitting in the market itself. We've corrected roughly around about 148 points. So that's not a bad little correction. It's only around about 2.8% since the top of the market, which was 53 and 1 point. So that's not a bad correction. Normally for a proper correction you need to see roughly around about a 5%, and we are heading in that direction. It is healthy, and we have been put there probably by the issues going on in Washington, but it will be probably governed by what happens at 11:30 today. We are looking at those job numbers, and since we've seen the change of government and a little bit more certainty around markets itself, there has been a bit of a push in the other direction. Expectations were for a 6.25% unemployment rate by this time next year. People are starting to come off that at the moment, and the top of the range of 5.8 at the moment looks like it will hold true this morning. If it doesn't, we'll probably see a bit of a drop in the Aussie dollar and a bit of a volatility movement in the ASX. But all in all, that's probably what we're concentrating along quite heavily here today. Other thing to watch, there is a couple of new yuan loans going out in China. It's not hugely important for us here in Australia, but it will be interesting considering the Chinese have a huge amount of foreign debt, particularly in the US, and if they do start to swap to a domestic focus rather than an international focus from their own bonds. So that's another thing to be aware of. If it's well bid, it does see that the Chinese are still seeing markets as a very good place to be, and that will be supportive for our market. But all in all, it does look like a bit of a weak day today, James, and that's probably led by the fact that commodities were weak, gold was off, and also major LME, copper, etc. was also off overnight.
Yeah, oil really slumping as well. We saw oil inventories up by about 6.8 million barrels of oil. Do you expect that to flow through to the energy space?
Yeah, you probably do, and we have seen that over the last week. You've got to look at regards to, a lot of people ask the question of why is oil, etc., coming off at a time where volatility is high. You'd expect people to actually buy into it. It is seen as a risk asset, and for that reason, we've also seen stabilisation in the Middle East, and it did really run up on that. So it will probably feed through to particularly things like Santos, Oil Search, and Woodside. Oil Search particularly has a fairly, it's not a huge amount, but a reasonable size of their oil component in their EBITDA coming out of there as well. So that's probably where you'll see it. We're also sort of looking at the gold space. Gold again was really quite flat to actually negative overnight. And considering we've seen a disconnect between the gold miners and also the gold pace itself, the negative double could also therefore affect them as well. So that'd be another place to watch. Watch Newcrest. We did see obviously yesterday some big news regarding their board and what's going on there, and that may also see a little bit more pressure on the stock as well, as we do see a bit of a change over there, and people sort of clocking onto the idea that yes, they have had a fairly tumultuous 24 months, and the CEO and chairman themselves probably have to fall on their swords for what's happened. But gold being off as well may actually see that the gold space also having a bit of a weak day as well, James.
Just looking at some of the what transpired this morning and overnight in the US, there seemed to be some growing optimism that we could potentially see a deal to avoid breaching the debt ceiling limits on October 17. Look, do you see that flowing through to our session? I mean, how much stock do you place in it?
Yeah, I think you've got to look at the trading across the intraday of the Dow and the S&P. Very interesting when there was news reports coming out that Barack Obama himself had said that basically, look, we will put things on the table, we will put the Healthcare Act, we will put other provisions on the table once you open the government again. So that was the condition on it. They'll talk about it for the debt ceiling as long as you open the government. And that was a bit of a positive. It's sort of a fairly positive move ahead at around about 11 a.m. over in New York. And that continued through to the day. The interesting thing that happened towards the end of the day, and the reason why the Dow and the S&P fell quite heavily into the close, was that there was also a couple of Republicans, particularly a prominent one from Alabama, that actually came out and said that they were looking at maybe the possibility that a default on their debt isn't actually a bad thing, and his sort of assertions from it was that we need to look at where our debt is managed and how we manage our budget, and all that kind of material came into it, and that really put a bit of a dampener on it. It may feed through to our markets today because that suggests that the partisan politics unfortunately still isn't there, even though a possible olive branch was given, and that would be where you'd see the feed through into our market. So I think we've been very, very rational here. We've been following the Asian markets and the Asian trade very closely, which is a good thing. We've seen really good things out of China and really good things out of Japan, but the closer and closer we get to next Thursday, and the more and more partisan government and policies come to play, and there isn't a deal done, the more and more nervousness will come through. As I said at the start, it's not a bad thing. We do need to see a correction in the market to keep going the way we've been going. Earnings season over in the US is kicking off. It does look like it'll be on the upside for the cyclical stocks. We have seen a real good upgrade in the EPS line because they saw an economic uptake there as well. So that may offset it. But all in all, hopefully we continue to follow the Asian trade and that rationale than the political issue that's going on in the US.
FOMC minutes also somewhat overshadowed, I suppose, by some of the US political stalemate discussions, as well as Yellen being nominated for that Fed chair position. Did you take much out of the minutes?
Yeah, I did, and I think it's quite an interesting thing. A lot of people have been talking pretty much since that May 22nd, what I call the Freudian slip by Ben Bernanke, about the possibility of taper, about the communication coming out of the Fed, and I think these minutes illustrate that almost perfectly. The difference that we've got at the current situation is that obviously most of them expect tapering to happen sometime this year. Now that will be probably put on the back burner considering what is going in Washington and the economic instability that's been caused around that. I think what you got out of it, and the crux of it at the moment, is that QE1 and QE2 were fixed asset programs with a fixed time and a fixed amount. The issue at the moment with QE3 is that it's an open-ended purchase program, and they always therefore try to put some form of levers on it that would therefore create it to come back, and that was to see a sustainably improving labour market. Now, from the get-go, they've never agreed on what exactly that is, and that's where we can see that filtering through in the market right now, in the fact that the crux issue there is that the dove sides believe that substantially means 6 to 6.5%. The neutrals and the hawkish side are sort of seeing that at 6.5 to 7%, and that's where the issue is coming about with the negotiation and the miscommunication to the market. And the reason we saw a fairly big run up in the bond markets, which then filtered through to the mortgage rates over in the US, was because of this miscommunication, and that was the reason why they didn't taper, was because they were concerned about the mortgage rates getting too high and that actually having an economic effect. So that's where I took out of that. It was a perfect illustration of the miscommunication to the markets and the misunderstanding between themselves with what they're going to do with QE3, considering that it's an open-ended program, whereas QE1 and QE2 were not. And that's where we've got this issue, and now we can see QE going through to at least mid-2014, with analysts talking about the shutdown issue affecting the members' confidence on that back.
All right, Evan Lucas, thanks very much.
Thanks, James.